All right, ask me some questions. What you got? All right, so first question, which indicators are you using on TradingView? So currently on this specific setup, mind you, I use different setups for different, market environments and different trading strategies. For this specific one, this is more for day trading. I use VWAP, definitely the VWAP. This is fantastic for day trading and for scalping with entries and exits. I also use 50-day moving average. And I use 200-day moving average. Definitely recommend using 200-day. Pretty much every single strategy you use. It's very, very powerful. And then I use the 300-day. Now, excuse me, another one that's kind of slept on actually is the 450-day moving average. I found a lot of success with that on the 15-minute time chart for day trading, and it's also definitely very good for the larger time frames, because if you get a bounce there or rejection at that level with your price action of the 450, that's a very good confirmation of potentially an entry. So that's more for like day trading and scalping in a sense, for those indicators. Now, other good ones to use, I wouldn't necessarily really recommend these for scalping, like TTM squeeze, stochastic, any of that type of stuff that people like to use in here. I wouldn't really recommend that for scalping, simply because if you think about it, they're more like lagging indicators, and you don't want lagging indicators while scalping. You want real-time shit while you're scalping, right? So for scalping only, if you were a scalper, pretty much all you necessarily really care about is maybe the 200-day moving average and VWAP, and then price action and volume. Everything else is basically just straight noise for scalping, because it's very quick paced. You're in and out. You do not want anything lagging. Your VWAP is not a lagging indicator. It is real-time average price throughout that day. So just to kind of keep that in mind. So, and then more for swing traders, to kind of flip the script here. Now that's when TTM squeeze, stochastic, Bollinger Bands, like all these other indicators are very, very useful for swing trading, because if you can catch like a large time frame, maybe a squeeze firing for XYZ stock, that's a good indication for potentially a swing trade. You could enter in a swing trade because a squeeze is being fired on maybe like a 4-hour time frame, right? That's some good stuff right there. So different indicators are for different pretty much trading setups and trading styles. You definitely don't want to be using like a TTM or like stochastics or anything like that for scalping. Now you could probably use it for day trading. I just wouldn't really recommend it for scalping, because scalps are very quick in and out. And that's just also my personal preference. You might have a different preference, but that's just what works for me. Less is more personally, because like lots of people use like 5-10 different indicators. They're using all this different brain power to look at all this different shit, and they're overlooking the something that actually matters the most: the price action, the volume, right? You're looking at all this other stuff, but you're overlooking the stuff that matters the most. So kind of keep that in mind. Less indicators is always the better. Hope that one answers your question. How do you know the hedge funds use the 200-day moving average? You can Google it if you don't believe me, but I can assure you they do use the 200-day moving average. Historically, the algorithms like to place buy orders, or they like to place sell orders on the 200-day moving average. So that's definitely something you want to have on your chart. What do you think of NFTs and futures? NFTs I'm not going to go into, because I'm kind of ignorant on that subject. I'm going to be quite honest. So I'm definitely not going to go into that subject. Futures, Ronzo talked about futures in the last session. If you want to go back and check it out, very, very good little lesson he wrote about futures versus options. The VWAP has 3 lines. Which are you using? Good question. Yeah, absolutely good question. So let's kind of go into that. I use the middle line for the VWAP. I don't use the upper band or the lower band. I just care about the mid level. I want to see where that middle area of pretty much the liquidity is sitting. That's where I really care about. If you just to like show visual representation of what the lower and higher band looks like, it's kind of like that. In a sense, it's kind of like where your price target will be. You can use this entirely up to you, but if you look here, the VWAP, the bottom one kind of was down here and then starts kind of retracing back. I don't like these personally. You might like them, but I usually just use the middle VWAP band. I don't use the upper or the lower. Can you talk about the VWAP cross? Yeah, absolutely. So, all right. So, okay. All right. So actually, let me look at one that's a little bit easier of a setup. One sec. All right. So there we go. This will probably be a better indication. All right. So we get a trap in the morning, come back down. We trap out sellers. We trap out the bears. Pretty much start range bounding in between this area, right? And then if you look here, the price action comes through this VWAP multiple times. So it comes down below it, that's considered bearish, comes above it, that's considered bullish, below bearish, above finally with bullish. Now look at the 50-day moving average. 50-day moving average did not cross this entire time. It did cross right here though, confirming a bullish thesis. So we have a large momentum candle above the VWAP and we start getting a little crossing. So that's kind of a double confirmation, right? Double confirmations are awesome for us. So then this is considered a VWAP cross. So we cross to the upside and we're considered bullish. Over here, we actually, if you look here, remember that 200-day moving average we talked about? Look at that. That's the cleanest rejection we've had all day. That's very, very clean. All right, so 50, 200-day, 100-day, 300-day, like all these different larger moving averages are key. But the big, pretty much daddy of them all is the 200-day. Because look at that rejection, that's perfect. If you entered, you could have been in calls here and took profit at that rejection, and then you could have flipped the script and went short, right? You could play both sides of the market, right? So then if you kind of just, we kind of actually had a double top right here. So one top, two tops, that's a secondary confirmation of a bearish bias, broke through the trend line, and then we just kind of flopped down. So this could have been great trades here. This is a 5-point down, and this is a 3 to 4 point up, right? So that's kind of a VWAP cross, is when the price action crosses above or crosses below. It's either considered bullish if it crosses above, bearish if it crosses below. Now, and then if you have other confirmations, like we talked about in our last little session before we end it and restart it, remember, these are even bigger crosses. So like when the larger moving averages come into effect, you know, like when the VWAP crosses below the 50-day, the 200-day, you know, all these different ones, that's an even stronger confirmation of a bearish bias. Now, let's just say hypothetically we crossed upwards, you know, let's just say all this stuff didn't happen, we crossed upwards. That's a confirmation of bullish bias, right? So using these indicators in conjunction with other indicators is very powerful. And this way, you're not really, you know, overwhelming yourself. You're looking at a couple different things. You're not looking at anything else. You're looking at volume, which I don't have on right now, but let's just say right here. Now, this isn't what it usually looks like, but just visually, I would have volume. I would have a couple moving averages, the key ones. You know, I would have my VWAP. Look at volume, look at price action. That's all I care about. Right? You don't need to overcomplicate it. You don't need to, you know, you got to just simplify the process, because let's just say I have all these different indicators on my chart, you know, and it's so cluttered that my brain power is being used with other different shit. And you don't want that. You don't want your brain power to be, you know, clogged. You want a focused brain power on the stuff that actually matters, which is the volume and the price action. Hope that one answered your question. Let me continue to go lower. Do you use RSI, MACD, or any of those indicators? I personally do not use the MACD. I do use RSI, but I use stochastic RSI. So it's a teeny bit differently. Just to really quickly go over that, what I mean by RSI not being my favorite, just to show it visually. 1 second here. Put that puppy on maybe. Hello. Oh, there we go. Sorry about that. That was a little laggy. Okay, so all right, so I'm trying to find you a good example real quick. Just really quickly on why I don't like the RSI stuff. Okay. Actually, you know what? AMD is probably the best answer. Hold on 1 sec. All right. Here's a perfect example of why RSI is garbage half the time. So usually if you see people talk about RSI, they're like, oh, it's an oversold territory, time to sell, or oh, it's in oversold territory or overbought territory. So in this case, we're in overbought territory, and this is where people like to sell. They're like, holy shit, time to sell, we're in overbought territory. Show them this chart. We're in overbought territory for days. Look at the chart. We kept going higher. This is why I don't like RSI. Same thing for oversold. It's like, I'm not saying they aren't useful, but don't rely on them, because just because it's overbought doesn't mean it's going to retrace. Because this is the example I would like to show someone. We're in overbought territory. Look at it. It continues higher, right? So like, just kind of keep that in mind. 1 sec. Okay, hold on. Yeah, so I mean, you kind of have to think about it. So hold on, let me answer the question, or let me talk about the question. So Friday was a big flush day, but Thursday was pretty choppy. How do you distinguish between the two, and how do you not get chopped out of your trade and stick with the trade? So you kind of have to think about the broader picture. Like we literally just fell 15 points the previous day. We need some sort of consolidation factor to either go higher or lower. In this case, this is the consolidation factor. This is the range bound choppy day, right? So these are the days you got to think about the bigger picture. Just because we sold off the prior day doesn't mean we're going to automatically continue to sell off that next day, or we're going to automatically bounce that next day. That doesn't happen all the time. That consolidation day was needed so we could do something like this. We continue to even lower, right? So like if you see these choppy ass days and you see that clear range bound day, this is where you don't want to be sizing in very heavily. Like it's not, there's some trades you could have taken, like you could have took right here for this 15 minutes, probably could have took some of this right here. Like there's definitely opportunity, but it's a little bit more, not, how do I put it? It's not the best risk reward trade sometimes. So like you don't really want to be forcing that. Thus, what I mean by that is, so these type of days when it's like choppy and like not very, great direction, you either sit cash or you size down. So what I mean by that is, let's say you're in 5 contracts usually, and you realize it's like a choppy consolidation day, maybe enter 2 contracts, like size down. Whereas if you see a directional day, straight upwards or downwards, this is where you want to size up, because this is where you can get tons of money for your account basically in one day. Hope that makes sense. Kind of answered this one last session, but SMA or EMA, slow moving average for SMA is good for swing trading. EMA, exponential average, is good for day trading or scalping. Day trading, the 5-minute chart, which other time frames do you use? Good question. I use anywhere from pretty much the 5-minute to the hourly. you don't use the 9-minute or the 20-minute EMA. I'm not discrediting it by any means. I prefer to use price action and volume for my entries and exits. Or I like to enter during these key areas like the 50-day, the 200-day, all these different bigger, larger ones. Now, another one that's actually slept on a lot, if you like, good for entries, potentially exits. Check out the 5 and 10-minute EMA crossovers. That's more for, in a sense, quote unquote, aggressive entries. So you might have to play around with it. It's definitely a little bit different from the historical 9 and 21. 200-day moving average, which time frame do you use it on? Anything above the 5-minute, anything higher is basically just more confirmation. So like say if you find a 5-minute rejection on the 200-day versus maybe a hourly rejection on the 200 moving average, clearly the hourly is stronger. All right, so the larger the time frame, the more, in a sense, I guess confirmation, it has more merit the larger the time frame. Is there anything exclusive that you teach for mentorship? Are there any specific strategies you teach? Because you already give out a lot of info on your YouTube. Appreciate those kind words. Makes me very happy that you're finding value. I don't want to disclose all that right now just to get into it, but I definitely do teach a lot of different stuff more in depth. If you're ever curious, just feel free to DM me and we can talk about that personally. Next one, I use just regular VWAP settings. Next one, what time frame are your entries and exits? Good question, but it's a broad question. Are we talking scalping? Are we talking day trades? Are we talking swing trades? Just to break it down real quick. Scalping, I would probably enter, because you're in and out very quickly. You're probably entering on maybe the 2 or the 3-minute. If you're entering on day trades, maybe you would enter on the 4 or the 5-minute. So just give yourself a little bit extra confirmation. If you're entering swings, maybe try the 10-minute, try the 15-minute, So it really depends on the specific strategy that you have in mind and what style you're going to be trading. So that way, you want to first identify what type of style you're trading, then you can kind of, go from there. Because like, I'm not saying the 15-minute entry is necessarily bad whatsoever on like a day trading aspect, but like if you wait full 15 minutes, you're gonna miss a lot of move. Like say for this, for example, like here's the 15-minute right there, just so I don't remember where it is. Now, let's say if I'm on the 4-minute time frame, I could get in a lot sooner. All right, I can get in probably like right here. Whereas the 15-minute, I would be able to get down here. So I missed $2 of the move. So this is why it's important to figure out what your style is, then think about what time frames you want to talk about. You wait for the candle to close. Yes, absolutely. Absolutely. You want to wait for the candle to close. You don't want to be entering during the actual candle formation, because if you think about it, what's not to say, let me try to find one that's really shitty. I know it happened. Where's that one day where we just had a large, one second, I know it's somewhere, like this one right here. For whatever reason, let's say you're bearish right here. Let's say you were bearish and you were trying to buy puts. And then you thought, okay, we're making a lower high right here. I'm going to buy puts right here. And if you didn't wait for the candle to close, because it ends up closing up here, and you started buying puts down here, your entry would have been one, absolutely garbage, and you would have lost money immediately because you didn't wait for close, you didn't wait for confirmation. So definitely wait for candle to close. Is TradingView better than TOS for charting? Obviously, it's entirely personal preference. I prefer the visual layout of TradingView. TOS is definitely all right as well, but I just personally prefer the layout and the ease, in a sense, from TradingView. Is there a reason you do not use the 921 EMA crossover? I guess it's just personal preference. Because just because it crossed over doesn't necessarily mean it's a buy signal. It's pretty much just showing a possible direction, across either to the upside or to the downside, but doesn't necessarily equate to a buy signal. Whereas if I wait to see, maybe a rejection off the 200-day or the 50-day or the 300-day, I see a rejection or a bounce there, or a bounce or the rejection at the VWAP, that gives me higher conviction and possibly better risk to reward trades. Hope that answer your question. Do you think SPY is going to go down to 300 soon? Not sure about soon, because we do definitely have to hit 340 first. And then after 340, longer term, we could very well see 300. Is entering off the 1 minute not something you would do for scalping? You can do this if you are a good scalper. If you are new at scalping, I would not recommend this. Because as we said last time, 1 minute time frame has not been as reliable as it was 6 months ago. Like me personally, I used to enter and exit on the 1 minute all the time. I found out the hard way in January and February that entering on the 1 minute caused me some issues. I took some losses. So now I start at least looking on maybe the 2 or the 3 minute. Just kind of you keep that in the back of your mind. You said earlier that market makers stop hunt our trades when we set traditional stop losses like 10 to 20%. So is it better to choose a range or stop out when the trade is invalidated? Yeah, so that's a great question. So I get asked about this a lot. I kind of explained it a little bit before, but let's just say, let me try to find an example. All right. Let's just say for whatever reason, I enter calls like right here, right? I'm trying to buy the dip and I enter calls. Now I knew at 380.5, there is a demand zone and this is a strong level, right? So I'm already down, let's say I'm down, I don't know, 10% here. Down here, I'll probably be down about 22% and my stop loss was 20%. Knowing that there's a big demand zone here, knowing that we just fell a shit ton and we're going to possibly see a relief rally, would you cut here and take a possible loss? Or would you risk it for the biscuit and see if it bounces at this really strong area? If it doesn't bounce, obviously you cut it. But if it does bounce, cool. You can possibly get some of your money back. So that's why I like to have more of a specific range in mind. Now, obviously, I wouldn't really want to risk more than like 30% for a day trade, but like depending on my trade, it's different. One trade could be 7% stop loss, another trade could be 25% stop loss, right? Every single scenario is different. It depends on when I enter. It depends on what type of setup this is. It depends on lots of different criteria. Can you check TTD? Sure. In the weekly time frame. Not oh yeah, oh, right here. So yeah, it is perfect. Good call. Right there. That is a bounce and a respection of the 200-day moving average right there. So what that's basically saying is we need this area to hold 49.70, 49.60 area to hold, become a new support in order to shoot some more back up here. Next real target would be probably like $58, and then probably right here at like $60 to $63. How do you know when a time frame for you is no longer working if it's false breakouts? I posted a video in chat about how to trade breakouts and what to look for breakouts. So I'm just going to post that again in case you missed it. I don't want to go over that right now just in depth. 1 second. What else we got? When you use trend lines, how many times does it have to touch? Okay, that's a good question. So it really also depends on the time frame. Like, are we actually, hold on, let me take a step back. So usually when I actually make my levels for the day, like when I make my levels on Sunday night, which I'm going to do tonight, I'm going to probably look at the larger time frame stuff. So like, say for example, this is already scuffed. Maybe I'll do what's some random stock. There we go. So I'll get rid of VWAP because we're on the larger time frame. Okay, so clearly I'll probably end up using the larger time frames, right? Because this way I actually know, okay, hey, we bounced here, and then I'll use this smaller time frame, the daily, to kind of confirm more of a trend, right? Then I don't, because this is more for larger, value areas. It's like, hey, it's got to break this trend line to continue higher. Hey, it's got to break below this to continue down, fill this gap. And then you can make trend lines on the smaller time frame if you want. Entirely up to you. I usually like to stick with the larger time frame trend lines, simply because they hold, the highest merit. So ideally, I try to make trend lines above the 4-hour. I found the most success above the daily, like the daily, the weekly, the monthly. Also, another thing that's really slept on is the quarterly. I would highly recommend tracking that out as the quarterly time frame. Because if you look at it, that one that I just drew on, I think the weekly is actually holding strong on the quarterly. So it's basically saying one candlestick is worth 3 months of price action. So definitely don't sleep on that one. 3-month time frame is very strong. 1 second. My volume indicator, I use pretty much standard, besides one sec. I use standard besides, not sure what's not showing here. Oh, it's already built in. So I use pretty much a standard on this. On the Thinkorswim one, I changed the boxes around. So it basically gives more data in one specific box, so it's not just completely cluttered. But usually I just use the standard for this. So next question. So I meant, how do you know when to stop using certain time frames? Like you said, the 1 minute isn't working as good. Can you explain what that means? Okay, sure. So 1 sec. I'll just do a quick example. I mean, there's tons of different examples you can use, because it really depends on when you start being a participant, right? So like, hold on. Let me try to find a good specific one real quick. Okay, so here is a resistance area from the previous day. Did this candle close above it? The answer is no, it did not close above it. So that is an example of a potential false breakout, because people are going to see this, right? They're going to see this huge uptrend, huge volume candle, and they're going to be trying to take calls, not realizing that there is a resistance from the prior day of 50.30. Did the price action actually hit and hold 50.30? No, it did not. So if you enter calls here, you would have entered at the top and you would have gotten rejected. Whereas, let's just say, I'm going to use maybe the 3-minute time frame, for example. You would have seen that this is a clear rejection on the 3-minute. We did not hold a level, and we actually wicked off of it. So the seller stepped up, right? So on the 1-minute time frame, you don't see that. You just see, where did it go? You just see straight volume pressure. You just see lots of bullish pressure. You see that euphoria candle, and you potentially enter calls. But you enter calls way too late. You should have entered like probably here, if anything. but you waited until top of the move. So you ended up getting FOMO and are like, oh, I'm going to try to catch this move, and you got rejected on. So I wouldn't really recommend the 1 minute time frame unless you're like um, actually kind of know the price action and know like the levels and stuff like that. I'm not like bagging on the 1 minute time frame, and just not nearly as much confirmation as like maybe a 3 minute or a 5 minute. Because you can get faked out very, very quickly on the 1 minute time frame. So if you're used to the 1 minute, try the 2 minute. The 2 minutes not that bad actually. It can show a different picture, because if you looked at even on the 2 minute, you see that big rejection. See that? We see that big ass rejection. Why would we enter calls? So kind of keep that in mind. But anyway, do you guys have any other questions you want to talk about? I don't want to keep going too long. This is already about 30 some minutes as it is. Just whatever questions you have before we end our session today, just feel free to drop that in the chat real quick. What are your top 3 favorite strategies? Okay, that's definitely more of a broader question, because I would have to kind of explain them further in depth. But let me just kind of just overview them quickly. I like trap and goes. I like supply and demand imbalances, entering at the zones. I also like rejections / crosses of VWAP and EMAs with price action and volume. So what we kind of went over in the beginning of the sessions with the rejections and crossovers of VWAP and VWAP and moving averages, that's definitely a good strategy I like to use. Another one, supply and demand stuff, I have an entirely different video on my YouTube if you want to check that out. Definitely one to really watch, especially if you're not used to it. Definitely something to check out. So I don't want to go into that one, and I'll make another video sometime this week about trap and go. It's basically just I talk about it a little bit in the breakout video, like the breaking out trading video. I linked in the chat a couple minutes ago, but I'll do a more in-depth one sometime this week about trap and goes. It's basically just market makers, in a sense, finding the most liquidity, trapping people out to participants, and then going the complete direction, complete opposite direction. But these are my top 3 favorites. There's tons of other ones. There's like open breakout strategies where you're basically trading the beginning of the morning. There's morning fade strategies. There's 10 a.m. reversal strategies, midday reversal strategies. Like there's tons of different things. So it depends. Any good YouTube videos to watch? Honestly, I have a few bit of good videos to watch on my channel. If you have any other like recommendations or topics you want me to talk about, just feel free to just give me a DM or something, like, hey, can you talk about this, and I'll make a video for you. How much is mentorship? It depends on the hours provided. So if you're interested in that, I'll drop a link about this if you want to just check out my there you go. 1 second here, actually. There you go. And then my YouTube channel, if you want to check that out. There you go. But anyway, any other questions before I leave today, kind gents and kind ladies? Anything at all? What are your plans for the future as a trader? Travel the world and trade while giving back to others. Anything else? Awesome possum. Well, I appreciate you guys for listening. Thank you so much. I hope you have a great rest of your day, and let's have some fun this week. If you have any questions or you think about something after the fact, My DMs are always open, so just kind of just message me and we'll chat. But anyway, thanks again, guys, and I appreciate you guys for listening. I'll post this video recording a little bit later in the chat if you want to, check it out again. Toodaloo.